You look at the housing market from a macro perspective right now, and it really feels like we are dealing with a suspension of physical laws.
Oh, absolutely. Like gravity just stopped working.
Right. Because we've had this deeply ingrained expectation, built over decades of economic cycles, that real estate operates on a fairly predictable axis.
Yeah, the cost of capital goes up and the velocity of transactions comes down. That's real estate 101.
Exactly. But we are sitting in an environment right now with mortgage rates hovering stubbornly around 7%. And the affordability index for the median American home buyer is essentially flashing red.
Right, just completely sidelined.
Yeah, but then, when you peel back the layers and look at specific segments of this market, that gravity just isn't there.
It's completely absent.
We're witnessing a landscape that is completely defying the basic principles of financial physics.
Yeah, because the average buyers, like you said, are effectively frozen by the cost of debt. But there is a specific tier of builder out there moving million-dollar homes at a pace that, frankly, it borders on the absurd.
It really forces us to, completely reevaluate our baseline assumptions about consumer elasticity.
It does. I mean, we've been trained to view housing as this monolithic entity.
Sure, just one big market.
Exactly. But the reality is that we are operating in a deeply bifurcated economy right now. The overarching narrative of a housing slowdown is really just a statistical aggregate.
Right. It masks what's actually happening underneath.
Totally. It completely masks what is happening at the top end of the wealth distribution.
Which is wild.
You have this massive cohort of buyers who are operating entirely outside the traditional credit cycle, and builders who have tailored their operations to capture that specific flow of capital.
Which brings us to the core focus of today's Talk Tickers Deep Dive.
Let's get into it.
We are stripping away the corporate PR and dissecting the Q2 2026 earnings call from Toll Brothers, ticker symbol TOL.
A fascinating quarter, really.
Yeah. Oh, incredible. So our objective for this deep dive is straightforward. For you listening, we are parsing through the data, the guidance, and the underlying strategy to extract the actionable signals.
Right, for the retail investor.
Exactly. We're looking past the headline noise to understand the actual mechanics of their balance sheet.
And that margin expansion, which we'll get to.
Yeah, and what it all signals about the broader allocation of capital in the luxury sector.
Because, the Wall Street consensus leading up to this quarter was heavily colored by macroeconomic anxiety.
For sure. Everyone was nervous.
Right. There was this prevailing thesis that sustained high rates would eventually bleed into the luxury market, that the wealth effect from the stock market would hit a wall, and that cancellation rates would spike.
But Toll Brothers Q2 data completely dismantled that thesis.
Utterly destroyed it. I mean, we aren't just looking at a company weathering a storm here.
No.
We're looking at a company that has seemingly built a structural immunity to it.
Yeah, and to really grasp the investment thesis here, you have to stop thinking of Toll Brothers as a traditional home builder.
That's a great point.
If you categorize them alongside the volume builders who are, just fighting for entry-level market share, you are mispricing the asset.
You really are. They operate much more like a Veblen good.
Explain that for a second.
Well, they're essentially the Rolex of real estate.
I love that analogy.
Yeah, I mean, they're selling a premium lifestyle product to a demographic whose purchasing power is insulated from the day-to-day volatility of the Fed.
Right. The Fed's interest rate policy just doesn't hit them the same way.
Exactly. The Veblen good comparison is incredibly apt here. When you analyze the luxury goods sector during periods of inflation or mild economic contraction,
the high-end consumer rarely pulls back, right?
Right. They don't pull back on tier one assets. A Rolex buyer isn't financing their purchase on a 24-month variable rate credit card.
No, definitely not.
And they aren't deferring the purchase just because the prime rate moved by 50 basis points.
Right. They're converting accumulated multi-generational wealth or, liquid equity into hard assets.
Yes. And that is precisely the dynamic playing out across Toll Brothers' portfolio right now.
Okay, so let's anchor this in the Q2 headline numbers, because the sheer scale of the volume they push through the pipeline is just staggering.
Yeah, the numbers are massive.
Home building revenue for the second quarter hit $2.5 billion.
Wow.
I know, that represents a massive acceleration. And they crushed the midpoint of their own internal guidance by $110 million.
Which we really need to contextualize $110 million top line beat in this specific rate environment.
Yeah, break that down.
Well, in algorithmic trading, beats of that magnitude in a sector that's normally categorized as cyclical.
Like home building.
Exactly. It triggers massive recalibrations of forward estimates. It indicates that their conversion rate from foot traffic to signed contracts, and more importantly, from signed contracts to closed settlements, experience virtually zero friction.
Zero friction in a 7% mortgage environment. It's wild. And the unit economics are where it gets truly crazy.
Oh, this is the best part.
They delivered 2,491 homes in the quarter.
Okay.
And the average delivered price per home was $1,009,000.
Over $1 million.
We are talking about an average closing price of over $1 million across almost 2,500 units in a single quarter.
And crossing that $1 million average threshold is a significant psychological and operational milestone for them.
For sure.
But as any seasoned retail investor knows, top-line revenue in real estate is kind of a vanity metric if your cost of goods sold is eroding your profitability.
Right, you have to look at the bottom line.
Exactly. The true health of this quarter is found further down the income statement.
Okay, let's look at those profitability metrics. Earnings per share came in at $2.72.
Solid.
But the standout metric, the one that really dictates the underlying efficiency of their whole operation, is their adjusted gross margin.
Let's hear it.
They posted 26.2%.
That's huge.
That is a full 70 basis points higher than what they guided for.
A 26.2% adjusted gross margin in home building is elite territory.
It really is.
It demonstrates extraordinary pricing power. They are effectively absorbing any lingering supply chain friction, right? Managing their labor costs and still capturing a premium on the final sale price.
Yeah, beating their own margin guidance by 70 basis points. That implies that as the quarter progressed, they didn't have to rely on margin-diluting incentives to clear their inventory.
Exactly. They held the line on price, and the consumer just absorbed it.
Okay, and the forward-looking indicators are equally robust.
Yeah, the net agreements.
Right, net agreements. The leading indicator for their future revenue pipeline. They signed 2,834 new contracts.
Wow.
That's a 7% increase in units year over year, and an 8% increase in total contract value. That represents $2.8 billion in future revenue.
That's incredible backlog.
But look, I look at these numbers, right?
Yeah.
$2.5 billion in closed revenue, nearly 3,000 new contracts at $1 million a pop. And I have to ask the obvious analytical question here.
Let's have it.
We are in a universally acknowledged restrictive monetary environment. Mortgage applications broadly are sitting at multi-decade lows.
Yep.
Hitting these numbers in a tough housing market is wild. Are they just getting lucky? Like, is this an anomaly driven by a few hyper-wealthy zip codes? Or is this by design? Is there a structural mechanism protecting them from the macro environment?
It is entirely structural. This is absolutely by design.
Okay.
Toll Brothers has built an economic moat around their business model by hyper-targeting what we can define as the immune buyer.
The immune buyer.
Yes, they have actively filtered out the marginal buyer who is sensitive to debt costs.
Right.
And they've focused exclusively on a demographic whose balance sheets look more like, small family offices than typical household budgets.
That makes a lot of sense. So let's pull the data from the transcript to back that up, because the demographic profile of this immune buyer is fascinating.
It really is.
In Q2, 23% of Toll Brothers buyers paid entirely in cash.
23%.
Nearly 1 in 4 transactions for $1 million asset involved zero leverage. Zero.
And that statistic alone completely decouples a quarter of their revenue stream from the Federal Reserve.
Right. They just don't care what the Fed does.
Exactly. When 23% of your buyers are executing all cash settlements, the macroeconomic hand-wringing over, the spread between the 10-year Treasury and the 30-year fixed mortgage,
It becomes irrelevant.
totally irrelevant. Those buyers are monetizing liquidity events.
Like what?
Business sales, massive RSUs vesting from tech companies, or generational wealth transfers.
Okay, but what about the other 77%? The ones who are actually taking out a mortgage? Because that's where you'd expect to see the friction, right?
You would think so, but that cohort actually reveals a stronger fundamental position.
Really?
Yeah. For the buyers who financed in Q2, the average loan-to-value ratio, or LTV, was 69%.
Okay, let's translate that. Right. A 69% LTV on $1 million home means the average finance buyer is bringing over $300,000 in liquid cash to the closing table just for the down payment.
Exactly. Which is a fortress level of equity from day one.
It's massive.
Contrast that with the broader market, right? Where you see FHA loans at 96.5% LTV.
Right.
Or conventional buyers really stretching to hit 10% down while paying points to buy down the rate.
Yeah, scraping the barrel.
The Toll Brothers buyer is not relying on the mortgage to stretch their purchasing power. They are using the mortgage as a strategic liquidity tool.
Right. They could pay cash if they wanted to, probably, but they're deploying capital elsewhere.
Precisely. They are capitalized by robust stock market portfolios, significant wage growth in the upper income deciles, and most importantly, the massive locked-in equity they hold in their existing properties.
The existing home equity piece is critical.
It's huge.
We have a nation of homeowners sitting on sub 4% mortgages, completely refusing to sell.
Yep, the golden handcuff effect.
Exactly, the golden handcuffs. But what management noted on the call is that the luxury move-up segment, which is their core demographic, is actually their best performing division. It accounted for 62% of their home sales revenue this quarter. That's up from 59% sequentially.
Because the golden handcuff effect assumes the homeowner is constrained by the monthly payment.
Right, that they can't afford a new 7% mortgage.
But if you bought a home for $600,000 in, say, 2018,
Yep.
and it's now worth $1.1 million, and you've paid down the principal along the way,
Right.
you might be sitting on $600,000 or $700,000 in pure equity.
Just locked in the house.
Exactly. For the affluent buyer, the desire for a newer, customized asset overrides the math of keeping a 3% mortgage on a house they've outgrown.
That's a great point.
They harvest that massive equity, they use it to crush the LTV on the new Toll Brothers home, and the prevailing rate environment becomes a secondary consideration.
And the customization aspect you just mentioned is where the operational strategy of this company gets incredibly aggressive.
Oh, the design studio?
Yeah. When you visualize a custom luxury build, the traditional model is, a buyer securing a lot, hiring an architect, and grinding through an 18-month build cycle.
Right. Very slow.
But Toll Brothers is heavily reliant on a speculative building strategy.
Which is actually the engine of their current growth. 50% of their revenue in Q2 came from spec homes.
Meaning homes they started building without a contracted buyer.
Exactly.
But hold on. This is where the risk model seems heavily skewed to me.
How so?
Building a bunch of homes without a buyer lined up seems super risky if the economy suddenly tanks.
Yeah.
I mean, building a spec home means you are floating the capital for the land, the labor, and the materials with no guaranteed exit.
Right.
If 50% of their revenue is tied to homes, they just decide to build on a gamble, aren't they leaving themselves massively exposed?
It's a fair question.
Like, if demand freezes, they're left holding the carrying costs on thousands of half-built million-dollar liabilities. How does that not threaten their balance sheet?
Well, it's the classic builder's dilemma, right? And it's exactly what destroyed volume builders during the 2008 financial crisis. But Toll Brothers manages this through highly engineered inventory control. They aren't building these specs to completion and just letting them sit empty.
Okay.
The key data point from the earnings call is that they are selling 1/3 of these spec homes before the framing is even finished.
Wait, really? Selling $1 million home when it's just a concrete slab and some 2x4s?
Precisely. And the underlying mechanism, the reason they are aggressively pushing buyers into these early stage specs is entirely about capturing the secondary revenue stream.
The design studio.
Yes.
The design studio.
But design studio economics are arguably the most compelling part of this entire transcript.
They are phenomenal.
When they get a buyer contracted early enough to customize the home, upgrading the structural options, the premium lots, the high-end finishes,
Right.
that average buyer is spending $219,000 purely on upgrades.
That is $219,000 of discretionary spending injected directly into the final purchase price.
It's mind-blowing.
That represents an additional 20% to 25% on top of the base price of the home. And the margin on those upgrades is astronomical. The transcript notes those design studio revenues operate at a 40+% gross margin.
This is a phenomenal behavioral economics play.
Walk us through that.
Think about the psychological trap of the design studio. When a buyer commits to the base price of the home, they have mentally crossed the threshold of the major purchase.
Right. They've accepted the $1 million price tag.
Exactly. The friction is behind them. Once they entered the design studio, they are no longer making a rational real estate investment.
They're making emotional choices.
Yes, emotional lifestyle choices. They are choosing the waterfall quartz island, the automated smart home integrations, the premium outdoor kitchen.
Because what's another 20 grand when you're already spending $1 million?
Yeah, exactly. And Toll Brothers captures a 40% margin on that emotional spending, which drastically elevates the overall profitability of the unit.
But how do they get the buyer to commit that early? If I'm a buyer, why would I buy a dirt lot and wait 9 months when I could just buy a finished home down the street?
Well, they use highly targeted, disciplined incentives. Management noted they held their incentive packages completely flat at 8% of the gross sales price for the fourth consecutive quarter.
So they are effectively saying to the buyer, we will give you an 8% concession, maybe we buy down your mortgage rate for the first 2 years or cover your closing costs, but in exchange, you lock into the contract today while the house is just framed.
Exactly. They sacrifice 8% on the front end to remove the friction of the transaction,
Right.
knowing full well they are going to recapture 25% in gross volume at a 40% margin on the back end through the design studio.
That's brilliant.
And furthermore, this completely de-risks the balance sheet like we were talking about earlier.
Right, the spec risk.
By locking the buyer in early, Toll Brothers avoids the carrying costs of finished inventory. The proof is right there in their inventory metrics.
Yeah, they dropped their finished spec inventory by 28% in the quarter.
Exactly.
They're currently carrying an average of just 2 finished spec homes per community.
Which is nothing.
2 finished homes per community is an incredibly tight supply chain. It means they have zero distressed inventory that they need to fire sale. They are managing their capital with absolute precision.
Completely.
So let's pivot to the geographical distribution of this revenue. Because the macro data often obscures localized strength, right?
Oh, absolutely. Real estate is intensely localized.
And the earnings call highlighted specific markets that are essentially acting as independent economic zones.
The migration of capital post-2020 has permanently altered the luxury real estate map.
For sure.
The concentrations of high net worth individuals have shifted, and Toll Brothers has aggressively followed that wealth. Florida and Texas are the focal points, but the internal dynamics of those markets require some careful analysis.
Yeah, the transcript specifically isolated Florida, noting that demand improved across all their submarkets in the state. They highlighted a development in West Palm Beach where they are moving inventory at an average price of $3 million.
$3 million.
And the key detail, they are operating with gross margins in the low 30s on those units.
A low 30s margin on a $3 million asset translates to roughly $1 million in gross profit per door.
Per door. That is staggering operational leverage.
West Palm Beach is a microcosm of the ultra-wealth migration. You have massive influxes of financial sector executives relocating from New York and Chicago.
Bringing enormous liquidity with them.
Exactly. They aren't looking for entry-level housing. They require tier 1 luxury assets, and they are completely inelastic to price at that level.
Right. But the Texas data, however, is even more revealing to me, specifically regarding Austin.
Oh, Austin is fascinating.
Because if you look at the broader financial media, Austin is consistently highlighted as the epicenter of the post-pandemic housing correction.
Right. The narrative is that the market is oversupplied, tech workers are leaving, and prices are in free fall.
Exactly. Yet Toll Brothers singled out Austin as a major growth driver.
Yeah.
They pointed to a specific community in the Brushy Creek area of North Austin where they are selling homes at $1.5 million, again with gross margins in the low 30s.
This illustrates the danger of trading off macroeconomic headlines.
Exactly.
The Austin narrative of crashing prices is accurate if you are looking at the entry-level or mid-tier investor-driven markets that saw, rampant speculation in 2021.
Sure.
But the luxury market operates in a parallel reality. The Brushy Creek example is critical because management noted they face virtually zero new home competition in that specific zip code and school district at their price point.
That is the ultimate economic moat. They aren't competing with the distressed flippers or the volume builders slashing prices.
Nope.
They have identified a micro-market with high-income tech executives like Apple and Tesla still have massive footprints there who want premium schools and new construction. And Toll Brothers is literally the only supplier in the room.
It's surgical market segmentation. By isolating their land acquisitions to these highly restrictive premium zip codes, they immunize themselves from the inventory gluts happening just a few miles down the highway.
Which transitions perfectly into how management views the remainder of the fiscal year.
Let's talk guidance.
We've dissected a phenomenal Q2. But the equity markets price in the future, not the past. And the forward guidance management provided is arguably the most aggressive signal in the entire transcript.
It really is. I mean, in an environment where major macroeconomic institutions are constantly revising down their growth estimates, Toll Brothers raised their full-year guidance across every meaningful metric.
They are now projecting full-year deliveries between 10,400 and 10,700 homes, maintaining that near $1 million average price point.
Amazing.
And more importantly, they bumped their full-year adjusted gross margin guidance up to 26.1%.
Raising margin guidance mid-year in a high-rate environment is a massive vote of confidence in their pricing power and their forward order book.
It implies that their backlog, right, the contracts they have already signed but haven't yet delivered, it implies that backlog is locked in at highly favorable economics, and they foresee no need to increase incentives to maintain their run rate.
Exactly. But there's a specific nuance in the quarterly cadence that algorithmic models might misinterpret.
Yes, let's warn the listener about this.
Retail investors really need to understand it. Management explicitly warned that Q3 margins are going to experience a slight dip, projecting around 25.25%.
Okay.
But they immediately guided for a massive rebound in Q4, projecting 26.3%.
So what is the structural reason for this mid-year margin compression, followed by the Q4 spike?
It is entirely a function of the luxury settlement cycle and geographic mix.
Okay, unpack that.
In Q3, their delivery schedule is heavily weighted toward communities with slightly lower historical margins. Furthermore, they're settling a higher concentration of spec homes that were contracted later in their construction life cycle.
Meaning those specific buyers didn't have the full runway to hit the design studio and rack up the high margin $219,000 in upgrades.
Correct. The base house gets delivered, but the hyper-profitable customization revenue is missing.
Right.
That dilutes the overall margin for the quarter. However, Q4 represents the culmination of the luxury move-up cycle.
The end of the year.
Yeah. Affluent buyers have a deeply ingrained seasonal preference to close on new homes and get their families settled before the holidays.
Sure.
Therefore, Toll Brothers' Q4 pipeline is stacked with their highest margin, fully customized, built-to-order luxury homes. When that massive cohort of high-margin settlements clears in October and November, the aggregate margin snaps right back up to 26.3%.
This is a critical takeaway for you as a retail investor. When the Q3 earnings drop and the financial news chyrons flash that Toll Brothers margins contracted sequentially, the uninformed money might panic.
Right, they'll sell.
But the informed investor recognizes that the dip is already priced into the guidance. It's just a mechanical function of the delivery calendar, and the Q4 acceleration is already mathematically secured in the backlog.
It separates the fundamental investors from the momentum traders, you know. You are holding the asset for the full year operational yield, not the quarter-to-quarter accounting fluctuations.
Exactly. And the company is deploying capital aggressively to ensure that yield continues to grow.
Huge growth.
They are targeting 480 to 490 selling communities by year end. That represents an 8% to 10% organic growth rate in their community count.
Which is very strong.
But they are also executing inorganic growth strategies. Most notably, their recent acquisition of Buffington Homes in Northwest Arkansas.
Oh, the Buffington acquisition is a masterclass in strategic capital deployment.
Break it down.
When assessing a builder's growth, you want to see them entering markets with durable, non-cyclical economic drivers. Northwest Arkansas is one of the most compelling corporate ecosystems in the country. You have the global headquarters of Walmart, Tyson Foods, and J.B. Hunt.
And it isn't just those three companies. The vendor ecosystem is massive. Walmart effectively mandates that their major global suppliers maintain a physical corporate presence in Bentonville or Fayetteville,
which creates a perpetual pipeline of highly compensated corporate executives and vendor representatives relocating into the region.
Prime luxury move-up buyers.
Exactly. But entering a new market organically is incredibly difficult. You have to navigate entrenched local zoning boards, establish relationships with local trades, and compete for land against established local players.
It takes years.
It does. By acquiring Buffington Homes, who was already the dominant luxury builder in the region, Toll Brothers bypassed the friction of organic entry. They instantly absorbed a pipeline of 1,500 premium lots and an established operational footprint.
But look, expanding community count by 10% and acquiring regional competitors requires massive liquidity. Most builders are literally cutting their delivery outlooks right now. Toll Brothers is raising theirs. In a macroeconomic environment where the cost of capital is severely elevated, how are they funding this aggressive expansion without destroying their balance sheet?
They are funding it through an impenetrable balance sheet.
Okay, let's hear the numbers.
They exited Q2 with $3.3 billion in total liquidity.
Wow.
$1.1 billion of that is sitting in pure cash. Their net debt-to-capital ratio, the core metric of a builder's leverage risk, has been driven down to 15.4%.
A 15.4% leverage ratio in a capital-intensive industry like real estate development is incredibly conservative.
It's basically bulletproof.
It provides them with absolute operational freedom, and they are using that freedom not just to buy land, but to aggressively reward their shareholders.
The buyback.
Yeah. They reiterated their target of $650 million in stock buybacks for the fiscal year, having already deployed $226 million in the first half.
And share repurchases of this magnitude fundamentally alter the investment math for the retail shareholder.
Explain this share repurchase concept simply for anyone who might not know.
Let's look at the mechanics of financial density. When Toll Brothers utilizes its excess cash to buy its own shares on the open market and retire them, they are effectively shrinking the total supply of the company's equity.
Right.
The underlying asset, the land, the cash flow, the 26% margins, remains exactly the same size. But because there are fewer shares in existence, every remaining share claims a larger percentage of that asset and a larger percentage of the future earnings.
So making every existing retail investor's slice of the pie more valuable.
Exactly. They are engineering EPS growth and increasing the intrinsic value of your position without requiring you to deploy any additional capital.
It is the most tax-efficient method of returning capital to the investor. And what makes this entire financial profile so compelling is that they're executing this. Expanding the footprint, retiring shares, maintaining elite margins while managing significant inflationary pressures on the supply side.
Right. Costs are up everywhere.
We monitor commodity markets closely. Lumber has seen massive volatility, and labor costs are structurally higher. Yet management explicitly stated that their stick and brick costs, the direct materials and labor to build the home, remained completely flat sequentially.
Flat stick and brick costs in this inflation environment indicate massive economies of scale and ruthless supply chain management.
Yeah, how do they do it?
Well, a builder projecting 10,500 deliveries exercises immense monopsony power over regional suppliers.
Right.
If the spot price of framing lumber spikes, Toll Brothers leverages its volume to extract concessions from drywall suppliers, plumbing fixture manufacturers, or roofing contractors to neutralize the variance.
Because they buy so much volume, they can dictate terms.
Exactly. Additionally, they have optimized their production cycle time down to 9 months.
Oh, wow.
Yeah, reducing the time capital is tied up in a build directly reduces carrying costs and financing overhead, which acts as a powerful offset to raw material inflation.
Okay, so we've systematically broken down the Q2 performance, the psychology and demographics of their buyer, the genius of the design studio economics, and their forward-looking capital allocation.
We've covered a lot of ground.
Now, we arrive at the core mandate of this deep dive. What is the definitive, actionable bottom line for the retail investor analyzing Toll Brothers stock?
The signal coming out of this earnings call is unambiguously strongly bullish.
Strongly bullish.
For anyone holding or considering this stock, this earnings call is a massive green flag.
Okay, summarize the why.
For an investor seeking exposure to the housing sector, Toll Brothers represents a uniquely de-risked asset class. They have successfully insulated themselves from the biggest macro headwind in real estate, affordability.
Right, because their buyers don't care about 7% rates.
Exactly. They are a less cyclical, highly efficient cash-generating machine. They are growing their community count, maintaining elite pricing power, and actively rewarding shareholders.
And they are dominating the land grab, too.
Oh, absolutely. They dominate the corner of Maine and mainland acquisitions where smaller builders just can't compete.
Let's emphasize that Maine and Maine concept. In real estate development, the most critical variable is the quality of the dirt.
Location, location, location.
Right. Maine and Maine refers to the absolute most desirable, irreplaceable parcels of land in high barrier to entry municipalities.
Premium school districts, established infrastructure, strict zoning laws that prevent overbuilding.
Exactly. Smaller regional custom builders simply do not have the billion-dollar cash reserves or the pristine corporate credit facilities to lock up these multi-year land tracts.
They just can't play at that level.
Toll Brothers sweeps in, secures the premier land pipeline, and essentially builds a monopoly position within the most affluent micro-markets in the country.
And that leads to the ultimate philosophical thesis of the investment. It might feel uncomfortable to state it so bluntly.
Go ahead. So to put a bow on this for the retail investor holding the stock, is the thesis simply bet on the rich getting richer?
Well, yeah. The financial reality is that investing in Toll Brothers is an investment in the structural persistence of wealth inequality.
It is the objective reality of the current economic architecture.
Yeah.
The data is clear. The upper deciles of the wealth distribution have benefited disproportionately from the asset inflation of the last decade.
Oh, massively.
The stock market is near all-time highs. Corporate compensation at the executive level is robust, and the accumulated equity in existing premium real estate is locked in.
Exactly. And as long as the wealth gap, stock market performance, and home equity remain robust for the affluent, Toll Brothers is arguably the premier risk-adjusted vehicle to invest in that demographic.
They possess both the capital and the psychological willingness to consume high-end, customized assets.
They aren't just constructing shelters. They are manufacturing premium financial products for a demographic that is flush with liquidity.
And the execution of that model, as evidenced by this Q2 report, is virtually flawless.
It's incredible to watch.
It is a remarkable economic fortress. But before we conclude this analysis, I want to pose a final forward-looking scenario for you listening to consider.
Oh, I like where this is going.
We have spent this entire deep dive analyzing how the Toll Brothers consumer is entirely immune to restrictive monetary policy.
Right.
They are executing all cash transactions. They are dropping $300,000 down payments. They are eagerly spending $219,000 on discretionary upgrades in an environment where borrowing capital is historically expensive.
Yeah.
So if this demographic is displaying this level of aggressive, resilient demand while facing the strongest macroeconomic headwinds we've seen in 20 years, what happens to Toll Brothers' pricing power and the velocity of their backlog if and when the Federal Reserve actually does cut rates?
That is the catalyst that could fundamentally re-rate the entire valuation multiple of the company.
Exactly. Will cheaper borrowing pour gasoline on a luxury market that is already burning bright? If an affluent buyer is perfectly comfortable absorbing $1 million purchase at a 7% cost of capital, what scale of custom home do they build when that cost drops to 5%?
Right. It is highly probable that despite these record-breaking Q2 numbers, Toll Brothers hasn't even approached their theoretical ceiling.
It's a crazy thought.
A shift to an accommodative rate environment wouldn't just be a tailwind. It has the potential to trigger an unprecedented supercycle in the luxury housing sector.
And Toll Brothers holds the premier land positions to capitalize on it.
Without a doubt.
And with that thesis, we conclude our analysis. We have taken you through the paradox of a housing market that defies gravity, breaking down the operational mechanics, the psychological pricing strategies, and the formidable balance sheet that makes Toll Brothers a fascinating case study in luxury economics.
It's been a great discussion.
Thank you for joining this fast-paced deep dive. Keep parsing the data, stay objective, and most importantly, stay curious. We will see you on the next one.